You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome to the New Year's show, Tim.
Jim, thank you very much for having me. Hard to believe another year.
I know. The older you get, the faster it goes. How was 2015 when it came to cycles, Tim?
Well, it started off kind of questionable. And I don't know if you remember, if we even talked about it. You know, the shows run together. But, you know, we peaked. We saw the market last year in December. I say we peaked. We saw the market push up into a high in December of 14. And then from there, the cycle count got a little iffy, and the thing that plagued us throughout the year was whether or not the next intermediate term cycle low occurred in February or March. That was kind of a weird thing, and the reason was that, you know, the cycle count just wasn't clear was because the range was so narrow. I knew based on some of the stuff that was falling in place that that the market was trying to peak during that time. And then ultimately we did get the push into the May high. And from there, the setup continued slowly but surely. It continued to fall in place. Then, of course, we got the big wash down into August. And then we got this monster counter trend rally that has put everybody to sleep. And I don't think anybody realizes what has happened. And basically since February, there was a Dow theory non-confirmation began to form with the February high in the industrials, and from there, we've seen one domino after another fall in place, and then, like I said, in August we had the bearish primary trend change. We've had this monster relief rally, second chance rally, if you will. And other dominoes have fallen in conjunction with this rally. And, you know, one thing I said way back in 2009, I said the longer this rally lasts, the more dangerous it would become. And I didn't understand when I said that. I mean, I knew it was a 4-year cycle low. I knew that we were moving into a 4-year cycle top, and I knew that, you know, the degree of the rally. But what I didn't imagine was that it would have been stretched to the longest 4-year cycle advance in history. And I think that statement is very accurate. I mean, I don't think anyone can imagine what could happen or what the risks are associated with the setup that finally has pretty much fallen into place throughout 2015.
Why did it take so long for the rally to finally catch up to what the cycle said it should be?
Well, you know, the cycles, it should have peaked, you know, the 4-year cycle has averaged 48 months from low to low since 1896. I mean, that's an undeniable statistical hardcore fact. And, you know, we had the low in 2002. It was right on time. And then coming out of the 2002 low, they stretched it, blew it up into the 2007 top. And at that time, that was that top matched or tied the extended cycle into 1987. And we all know, I've said, and we can go there if you want. I'll just hit it briefly, I guess. But the market, the economy. When I say the market, the secular top of this stock market peaked in 2000. And that is evidenced by the volume of the underlying volume characteristics of the market. And let's just leave it at that, not confuse it. Confirmation of that, you can look at the underlying economy that also peaked in 2000. And confirmation of that can be seen with the job participation rate. We've talked about that. And the velocity of money. It all began to roll over in that 99-2000 period in conjunction with the secular bull market top. And what happened is real simple. They wanted to keep that going. They wanted to, and they tell you that's not conspiracy. They tell you, they're trying to rekindle the animal spirits. They're trying to get it going, and they cut rates, and that's where the manipulation really started. And they extended that 4-year cycle, out of the 2002 low. They extended that cycle and pushed it into the 2007 top. And it changed nothing. And when I say it changed nothing, it didn't change. The volume characteristics did not change. The velocity of money did not pick up. It didn't create jobs participation rate. It was futile. And so all it did was artificially inflate prices. It created the housing bubble, the commodity bubble, and in turn resulted in the worst financial collapse since the Great Depression. And, all throughout that time, 2005, 6, and 7, as we stretched into that cycle, I said it's an extended 4-year cycle, and it's only going to make matters worse. And I said that just merely based on statistics. And as that bubble pops and we roll down into the 2009 4-year cycle low, the crazy thing is that the solution to them in trying to fix things was to do more of the same that created the problem in the first place. And so, again, because of that liquidity infusion, they haven't fixed the job participation rate is still, it's still ugly. There's no change there. The volume characteristics of the market, no change there. And the velocity of money, no change there. It's done nothing. The price advance is real. Yes, obviously they drove price to a new high, but it is camouflage. It has camouflaged the underlying, I don't know how to say it, the underlying, the severity of the underlying problems. It's literally been like throwing a camouflage net on it, because everybody thinks, well, if the stock market's up, it just provides a little cover for just how bad things are. But just like the extension of the cycle in 2007 or into the 2007 high, all they've done is make matters worse. And so while the cycle has been extended again, it hasn't been negated. The shorter term cycles are still there. We're still seeing the little annual cycle, the intermediate term cycle. Yeah, it was a little sketchy back in February in identifying exactly where that low was. And so yes, there is some noise within the cycles, but they haven't negated anything. And it's setting up, continuing to set up. And, we're setting on, I think, the most dangerous stock market top and in the most dangerous stock market environment since the inception of the averages in 1896. And the reason I say that is because we've never been in this position to where we've had such an extended bubble that has been stretched under the circumstances in which it's been stretched. There's no solid basis, be it technical or fundamental, for prices to be where they are. It's hollow. It's like a levitation. And to have that levitation in conjunction with the extension itself, and then, the dominoes starting to fall for the setup, it's a recipe for disaster. And from that perspective, I maintain that this is the most dangerous setup since the inception of the averages. And, how fast it comes unwound, that I don't know. But I can just tell you that the risks are very, very, very high going into 2016.
We'll have more with Tim Cyclesman Wood right after the break.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Unbelievable harmonies, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band, Saturday, January 9th at the Alex Goulden Hall. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, some silver bugs have said the reason that prices are so low for silver right now is there's a government conspiracy to keep prices low. Anything behind that?
I don't know if there's a government conspiracy to keep prices low or not, but, there's always something fundamentally behind the price movement. Just like the stock market being where it is. Well, what's fundamentally behind it? The liquidity. Let's be real. The liquidity and the manipulation to push it up, the liquidity. Well, what I'm saying is that a cycle is a cycle and a chart is a chart, and it doesn't really matter what or why price is going up or down. It's still just a price bar. It doesn't matter. That's the very essence of technical analysis that people don't get. It doesn't matter why. It just is. And so I don't know if there's a conspiracy. I don't care if there's a conspiracy. All I know is the 9-year cycle in gold peaked in 2011. And I identified it. It's in the letter. And I said that every rally, and I know you start off talking about silver, but the cycle is pretty much the same in gold as it is in silver. And so let's talk about them in general terms together. And so the 9-year cycle top peaked in gold in 2011. And I said then that it would continue down until we got into the 9-year cycle, the next 9-year cycle low, which was due ideally in the 16-17 time frame. I think it's setting up now to probably bottom in the 16 time frame. And so that's going to be a major focus in the coming year, is identifying that cycle. And so if there is some grand conspiracy, it fits with the cycle. I don't care. It doesn't matter. And if there is a conspiracy and we get to this cycle low and the structure changes, well, then either the conspiracy is going to be exposed or they're going to lose control of their little conspiracy. I don't know what's going to happen, but it's going to go up, and it's not going to go up because of from my seat, the fact that the conspiracy is no longer, or whatever the case may be. It's going to go up because the cycle bottomed. And so, the fundamental reasons really don't matter. It's the cycle. It's the cycle.
Tim, what do the cycles tell you about the price of crude in the new year?
That we should be going, at this point, I still think it's going lower. I still think that there's, a good chance that we could see crude into the 20s. And I first wrote about that well over a year ago in one of the letters, and it was based on, again, statistical analysis. I said that we would get into the 30s, and we have. And I said that there was a good chance that it would go as low as the 20s. And I think ultimately at this point, I think that is still on go. I see nothing structurally to make me think that those levels are not ultimately going to be achieved. If something does happen structurally to alter that, then I'll be glad to explain that at the time. But right now, I think we're on target.
And again, people are saying we're at capacity for storage. They have to get the stuff out. That's why the prices are falling. Again, that's not what you're looking at, is it?
No, I'm looking at cycles and statistics. And that's the thing. I think we talked about this a few shows ago, but people need to grasp this concept. And it's true particularly with equities right now. It was true with oil. Jim, the thing that people need to realize is that it's with any market. That's what makes the cycle, is that you have a norm, and then the market will start to move above or below that norm, and as it goes up and up and up and up, let's say in the case of crude oil, it went up, and then all of a sudden you have the speculation that comes in, you have whatever it is that's driving price. Everybody knows that crude oil is going up. Everybody knew that it was because of China. Everybody, remember all the insanity and all the reasons that crude oil was going up when it was at $140 a barrel. It was going to $200 a barrel, and we were at peak oil and all this mania. And it's just speculation. It was a bubble. It was a bubble. And it was so stretched outside of the norm that it appeared normal. It stayed there long enough that the abnormal began to feel normal. And what people don't realize is that looking at the chart, even after 9/11, crude oil was in the teens. I'm looking at it. In November 2001, crude oil was at $16.70 a barrel in bottom. Made an intermediate term low at $16.70 a barrel. Historically, $40 has been the ceiling. It hit 40 with an extreme move, and it'd back off and pull back down. In 2004, we pierced the $40 ceiling, and we've been above it pretty much since. And after being above that level for 10 years, all of a sudden that become a new norm, if you will. But it wasn't. It wasn't a new norm. It was one hell of an abnormality. And now we've come back. I said, back at the 2008 top, which I identified the commodity bubble, that top, the week after the top, I saw it, identified it with my buddy John Grant on the air. And the commodity bubble burst. I said that we were going into a 3-year cycle low in commodities, and we did, and crude oil followed. And I said that the bounce out of that low would not exceed the previous high, which it did not. And crude oil peaked in 11 along with gold. And I thought that we would see the same behavior with equities. I didn't think equities coming out of that 2009 low were going to go to a new high. They did, okay, fine. But my point is that nothing else has. Everything else has collapsed, and everything else is reverting to the mean, and then equities are hanging here. And now, with equities being where they're at, that feels like the new norm. It feels, it's okay, it's normal. Market's not going down. It's normal. All this psychological stuff, it's an illusion, and that's part of the recipe that makes this the most dangerous stock market ever. And I'm telling you, it's been relentless. It has tried to set up, it's tried to crack, and it couldn't, and it wouldn't, and then it would, and then they've done a masterful job at keeping this thing together. But I'm telling you, it's coming unraveled, and when it does, it's going to look like this crude oil chart. It's going to be hell to pay. And the sad thing is that people aren't listening. Either they don't believe it, they're too stupid, and that's not being ugly, but it's just, I'm trying to, shake them. I mean, come on, think. It's not normal. And it's going to come apart.
How far will things fall when it does happen?
Statistics suggest that we go below the 2009 low, ultimately. We're talking 65-70%, I think, is the math on that. Sounds crazy. Maybe this time is different. I don't know. That's what the statistics say. That's the risk. That's the risk.
Is there any area that a person could move into that will be protected from that downfall?
Cash. What they're fighting, if you look at the reality, since 2000, what have they been doing? Back, just if people will think, what have they been doing? They've been trying to reinflate, trying to get it going again. Inflation. They're trying to reinflate. Why are they trying to reinflate? Because it's trying to deflate. And so in the process, it's one battle against another. You have the natural forces trying to deflate. You have the artificial stimulus trying to inflate, which it has in certain areas. I mean, they blew the stock market up into a new 4-year cycle low in 2007. Yeah, they created the housing bubble. We all know how that worked out. They created the banking crisis. We know how that worked out. They created the commodity bubble. We know how that worked out. And then we declined into the 2009 low, and now they've created this bubble. But this time, housing hasn't come back like equities have. Crude oil didn't come back. Commodities didn't come back in general. And so now we're hanging here with this equity thing, stretched out the longest cycle ever, and nobody even sees it.
Tim, I hope you have a great new year.
Jim, I do too. The sad thing is that no one has to be caught by this. I don't mean to be gloom and doom. I mean, it's not. Knowledge is power. And I know we've been talking about this all year, but the market has been setting up all year. It has. We closed this year with a Dow theory non-confirmation and the setup, continuing to evolve and it's not negative to know what is coming and to know these risks. What's negative is to not know or to be naive or to stick your head in the sand and be in denial and then get T-boned by it. That's the negative. And so I hope people will take heed. The research, if someone, it's just numbers. I got an email from a guy that subscribed. He mentioned you, subscribed through listening to the show, and he said, at first I was skeptical, but I've been a subscriber a while now, and I'm looking at this material, and he said, I see it. And it's truly amazing. And it's, like I said, it's just numbers. It's just math. It's just cycles. It works. And the fact that it has taken so long for this 4-year cycle to set up, that's outside of our control. It's still doing what it's doing. It's still an abnormality, and the damn thing's still going to come apart.
Tim, it's like a charging runaway freight train. It has its headlights on, it's honking its horn, but the person standing on the tracks has got their headphones on and they're looking at their cell phone, not paying attention, right?
Absolutely. And people, the problem is, like I said, when something, just get your mind around that. When something that is so abnormal is abnormal long enough, it becomes, people accept it as the new norm, and they just get in their mind that I don't know what they get in their mind. I mean, that you can never return to the norm. Hell, they forget what the old norm was or the real norm is. And so people are just people, and that's what creates the cycle, Fear
feeds on fear, and optimism, I guess, feeds on optimism.
Exactly. It does. And all that's part of the cycle. So anyway, it's setting up, and it's at this point, it's just going to be a miracle if it continues to linger. But like I said, the risks are certainly high. I think the collapse in commodity prices is telling us something, and it's just not good. And like I said, if people want the research, it is available at cyclesman.com.
Tim, thanks a lot for chatting with us, and have a great new year.
Thank you, Jim.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com Radio. Our YouTube channel is Talk Digital Network. Find us on Twitter at Talk Digital Net. If you have any comments or questions for the show, you can email them to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.